Welcome. We don't have too many people on at the moment, but I have a feeling that people are going to be floating in within the next 3 to 5 minutes. So just to begin today's session, a brief introduction before Diana and Valentino come on. This week's webinar series is all about how to analyze your China business. Yesterday, we were looking at tips and a flow-by-flow strategy of how to review your current China business. Where does it stand today? Where would you like to see it go? And today we've got Valentino and Diana in to explain to us what companies have to do in China in relation to the foreign investment law. Whether you're a joint venture, whether you're a sole limited company, what do you have to do to update yourselves to remain compliant in the Chinese market? Just before we begin today's session, there's only 2 people on right now. There's Liva, I hope I'm pronouncing your name correct, and Ji Hong. So Liva, I'm not too familiar with your background, but what would be great to understand is from the 2 of you, who you are. Are you startups in China? Have you incorporated your structures in China? Or have your entities been established for a certain period of time, longer than 5 years? This just gives a bit of background. Just as a reference point, my entity was established in Shanghai in 2018 because Woodburn is a relatively new organization. So we do have to abide by the new foreign investment law. However, I think our homework is not as big as those that have joint ventures in the market. But we'll learn more from Valentino and Diana in today's session. How the webinar works is that we're here to educate you. We're here to explain to you things that have to get done when you are in the Chinese market in order to avoid any obstacles or compliance issues. We may be selling our services indirectly, so bear with us if that does happen. But the idea is that we do educate you. Hopefully, Valentino will keep the presentation to about 60 minutes. And then he's got a fabulous quiz, which I absolutely love the idea at the end of the session to make sure you've actually learned something and you are actually keeping something in your mind from the presentation today. So do stay on for that. And if you do have any questions throughout today's presentation, please insert them into the chat box. And we promise to stay on until all questions and comments have been answered. This is 90 minutes of your time spent, so do use it wisely. We're here for you for any questions that you might have. From a technical point of view, we are using Zoom meetings. As such, if you run into any technical difficulties, please try to log off. Please then try to log back in. If this continues to not work, just know that we are recording today's session and the recording will be up on our YouTube channel by the end of this afternoon, European time. If anything happens to me, Valentino is a co-host, so he will be staying on. If anything happens to him, I will be staying on. It usually does take about 30 seconds to 1 minute for either of us to reboot and come back online, but we will be coming back online to finish today's presentation. Just a little bit about myself. My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I have been 17 years in the Chinese market based out of Shanghai, helping foreign investors with their market entry and expansion within the Chinese market. Our head office is based out of Hong Kong, where my brother, we're a family-owned business, is managing our operations. We've been helping clients with all of their administrative needs when going into the market, from Chinese company incorporations all the way through outsourced solutions from accounting, tax, payroll, recruitment, and just general compliance issues. I am the creator of the China Roadmap Methodology, the China Incorporation Blueprint, and the China Profit Accelerator. And just newly, I've also created 8 steps to succeed in China, which hopefully I will be launching next month in a webinar format. So enough about me. Let's move on to Valentino and Diana. Today's topic is about following the change, what foreign invested enterprises shall do to be compliant with the new foreign investment regulations in China. I'm going to stop my share, and Valentino, you can unmute yourself and share your screen. You're muted, Valentino.
Just a second.
There we go.
Yes, now we all ready.
Yeah, can you hear us now?
Yes.
Hello, everyone. Good morning to you guys in Europe. It's afternoon here in China for those of us that are in China. Very happy to be here with you, and having a small group is actually quite a pleasure because I hope we have a nice discussion after the presentation. And it would be great to hear where are you in terms of your journey in China, and how can we help you, or is there something else that we can offer you as knowledge? And companies are so different, so it's always interesting to hear from a different business perspective. So please do not be shy to come up with questions or share your stories or get involved. It's just a handful of us now, so we can afford a really nice conversation after this presentation. So I'll start my part. So I will start with a brief overview of the new foreign investment law, which, as you already know, has been implemented beginning of last year. So we are already a year and a half into the new investment regime. And as it will become clear, there are several things that you have to take into account, because this is indeed quite different legal framework from the existing one. And I will not indulge on this now because we have slides on this. So this is the agenda. We'll talk a little bit about the general framework, and then we'll dive into what existing businesses are facing as need to change in terms of corporate governance, but also in terms of what other changes might be coming out of this new legal framework for you guys. But first, a few words about ourselves. My colleague Valentino and I are both based in China, in southern China, in Guangdong province, in Guangzhou. We both work for one of the really very well established, and in terms of foreign related business, one of the pioneers and one of the leaders in southern China, law firm called Wang Jing and GH law firm. We are a mid-sized law firm when it comes to Chinese standards. We have just 100 lawyers in this one office here in Guangzhou, and we cover really a wide range of of legal issues and aspects. Pretty much we're all-round legal service providers. So any questions that you might have, it's always worth asking, because it's more likely that we can help you rather than not. And even if we cannot, we know people that could do this. We're also proud of the fact that we have people coming from different cultures and speaking various languages. You can see on your screen our little flags. There is a flag that you probably won't recognize, and is the one on the second row in the middle. Maybe this should be part of Valentino's quiz, but anyway, I'll give you heads up. As you can see from my accent, I'm from Eastern Europe, and I have the suspicion that somebody else might be from this same region. Anyway, at the end of the presentation, we'll see whether we figure out whose this flag is. So enough with the jokes. We are a great company. If you have a need of any lawyers, please call us and don't think of anybody else. Back to the topic, new foreign investment regime. As we mentioned, it's really a new legal framework for foreign businesses in China. And the whole package of new regulation includes the foreign investment law itself. They published a regulation on the implementation of the foreign investment law. There was a Supreme Court interpretation of the foreign investment law, which is quite important. And there are several reporting regulations which involve some of the technicalities around the information you have to provide, who you need to provide it to, and all these supposed to facilitate foreign businesses in China. At the same time, this whole package abolishes the existing laws which were governing the foreign investments so far. The wholly foreign-owned enterprise law, the CJVA and the EJV Law. So all companies that pre-existed before 2020, when the new foreign investment law regime entered into force, will have to go through certain transformations. And my colleague Valentino will speak more about this later. Around this core of new legislation, there is a satellite of other regulations, which are the new negative list, the security review, the expanded encouraged catalog, the unreliable entity list, export control, blocking rules, IPR protection, and I can probably carry on, but that's not the focus of today's topic. So let's just quickly go through the main changes that the new foreign investment law introduces, because there are changes on paper, but also in terms of perception and how foreign investors are seen and should see themselves. So there are certain, there a little bit more clarity and a little bit kind of more wideness, or if you want, in the scope of what foreign investor and foreign enterprise is. So these are all the investment activities in mainland China, which are conducted directly or indirectly. This time explicitly stated that indirect investments, foreign investments, are also in foreign investments. So if you might have considered yourself until yesterday not included in this regulation, now the new definition and the new scope should kind of prompt you to reconsider where you stand really in terms of the legal framework that you have to comply with. You can invest by yourself, you can invest with a Chinese partner. There is not a cap on the share of the foreign investment to be considered a foreign investment. And there are several other principles that, that have been changed. So the other main change with the new framework is now all foreign investors have to be incorporated, and the companies, foreign invested companies, have to be incorporated under Chinese law. So this require, if you're considering making a new investment, to really study what this would apply, or if you're an existing entity and you have to transform, you again have to study what this would imply, because in addition to the transformation process, which will make you compliant going forward, you have to familiarize yourself with the Chinese laws that will apply directly to you. So all these kind of long wishing dream of foreign investors to be equalized to Chinese entities have now came true, but they require some certain homework. And the new principles that this new legal framework explicitly states are, as I mentioned, application of the local law. They require really explicitly equal treatment. So whatever challenges you might have, whenever you might feel that you haven't been treated equally with a Chinese investor, you have now explicit tools and explicit power given by the law to request to be provided this equal treatment. And we had, if you follow the series of seminars, you know that there was a week when we were talking about new entities and the new changes in the foreign investment law. So those that might have joined these seminars, I'm not going to repeat myself, or you might go back and see at the library and find these older presentations. So all these new framework are supposed to really give you equality with Chinese entities. So please do seek them because they do exist, and we'll start seeing court judgments which will reconfirm this. So don't be shy and don't be afraid to look for your rights. One of the key things that the new foreign investment regime stipulates is that the so-called investment contracts should be respected. And those of you that have been in China for quite a while do know that every investment starts with investment agreement with the local government, whereby you agree, if you're a company of substantial scale, what are going to be the terms of your taxes, what sort of land you would be offered and at what price, and what other incentives or disincentives or you might be subjected to. So these contracts are extremely important for all businesses starting in China, and have been subject to a lot of disputes and a lot of grievances where certain changes of political moods or changes of personnel or changes of policies and kind of general policy directions could have obstructed the enforcement of these contracts. Now is explicitly stated that this cannot be the case anymore, and whoever the administrative organ who you engaged with should respect these contracts. And this was kind of reconfirmed by the Supreme Court clarification, which suggests how important the issue is, because the Supreme Court of China does not kind of issue interpretations and clarifications every day, I can tell you this. So this is recognized as an issue. And in the Supreme Court clarification, the court explicitly clarifies what investment contracts are, and in what cases the court, even if you have a case which is starting now, or you're in the middle of a case which started before the entering into force of the new foreign investment law, how the court should respond and how it should respect. And the general rule is that these contracts should be respected, even though they are under the old regime, unless the business that is in question is prohibited by the negative list, or at least the contract has been signed unlawfully. So apart from that, pretty much the demonstration is that the court would like to honor all the agreements that have been signed before the new foreign investment regime. So if you happen to be in the middle of a process, or and you are not sure what the outcome would be, you should know that this clarification does not just apply for these specific circumstances, but is kind of a showcase of the direction of where Chinese courts would like to be seen in terms of protecting foreign investors and in terms of ensuring continuity and legal enforcement of all the contracts that different parts of the Chinese administration sign. And here I'll hand over to my colleague Valentino, who will go through the most important changes which will probably concern most of you.
Thank you so much, Diana, for your nice presentation. Thank you again, Christina, for the invitation. I'm very happy to be here, and let's say go through the changes regarding corporate governance that happen in China. I did a similar setting a few weeks ago, and I started with something that people are not well aware of. It is the fact that a company, a corporate, is a fiction. It does not exist. You cannot hang out with a corporate. You cannot have a drink with a corporate, right? But many people can argue that, yes, but corporate has a table, so table is a physical entity, right? Those are corporate assets. The corporate per se is an invention of human speed, right? And because it's an invention of humans being, we need a way to convey or to represent how this company really act, how a company take decisions, right? And this is important to keep in mind because we will see in the corporate governance different people with different role and responsibility and duties. I usually classify the corporate governance as the basic part of the Jenga game, of which on top you have the money, right? If the base is weak, so if your corporate governance is weak, maybe all the money fall, right? You cannot really achieve your scope. So, but what's really important in this regard? Why the company is a fiction, so cannot act by itself, but it needs people. What kind of people the company needs? I put here a list from the presentation of major, let's say, figures that you will see in the corporate governance. You may be aware of the shareholders. Who are the shareholders? Here represented with money are usually people that invest in a project, right? Later we have directors that by the name are people that direct the company in the major decision. Under the director, we have general manager, that is somebody that follow the daily operation of the company under the instruction of the directors. Later, we have supervisor, that is somebody that control the work done by the director on behalf of the shareholder, is represented with a lens, is somebody that is there saying, hey, director, you're doing something wrong. The shareholder does not want that. Many people in China make the mistake of choosing the wrong supervisor, and later they will regret it because the power in the hand of the supervisor is immense. If you are a shareholder, you invest money, and your director is doing something wrong, the person that could file a suit against the director is you as a shareholder or your supervisor. So please mind to select the right personnel to be in the place of the supervisor, to become a supervisor. The last one is a legal representative. The legal representative is a person that represents the company to the outside. It is also the person name that you would see on the business license. If any of you register a company before in China, you will see that there is a name there written under the name of the company. That's the legal representative. This person has certain obligation and responsibility for the act of the company. So why I'm explaining all this to you? Because the way those people interact is actually decided by the corporate governance. Here I make a representation of the system before the foreign investment law. I usually classify corporate governance like the instruction to build something that you bought from IKEA, right? So if you are a 100% foreign invested company right now, the instruction seems pretty easy, right? So I know that I need to apply the company law and I need to appoint certain number of director, need to appoint certain number of supervisors, etc. But using the old regime, what happened is that if I need to build this table together with the Chinese, the instruction become messy. So you have the example to the right. So the only fact that I'm having a Chinese partner to invest together with me because I'm a foreigner change all the rules. And if this Chinese partner leave and my company become again 100 foreign invested capital, this structure becomes simple. So this creates a lot of obstacles for people to maybe engaging with a Chinese partner or for a joint venture to become a wholly foreign invested company because the instruction keep changing. What the foreign investment law did is said, no guys, we just gotta use one set of instruction to build the IKEA table. And those instructions will be the company law or the partnership law. No matter if your partner is Chinese, your partner is foreigners, and how many partners do you have? It will be one set of instructions, you just need to follow them. And this clarifies a lot, because think about it, if you are a Chinese company and you have a lot of talents, and those talents are foreigners. Maybe you are an internet company, right? If you give shares to these foreigners before, you need to change the structure of the company and become a joint venture because the capital will be mixed, right? But right now, because the regime changed, no matter if you give shares to a foreigner to a Chinese, the company will still be considered foreign investment enterprise. Same set of rules. And these actually have effects on all the corporate decision making. So here we have in the first slide, decision making organs. If you were a joint venture before, okay, before the reform, the supreme organ of the company was the board of directors. So who is the board of directors? Is a board means a number of people, a committee of directors. So the supreme organ of a company is not the investor, is not the one who put in the money. So the idea before was that you have a guy full of money, invest the money in the company. He appoint, for example, Diana to take decision. Diana is the director, and Diana can do what she likes. Okay, and that's gonna be the highest decision-making organ, right? And me as a director, as a shareholder, I have no control because the only things I need to do, I need to pay the money. Okay, this was the structure done before. Right now, things change completely. Okay, so if right now you do a joint venture or a wholly foreign invested company, you will know that the highest decision-making organ is the shareholders meeting. Means the investor maintain a certain control on the operation of the company. So if the directors do something stupid, you can actually take action against them. In addition, because you are the supreme organ, there are certain power that are just in the hand of the investor, of the shareholder. So you don't need to be worried that the director maybe liquidate the company. This is something we will see later. So we passed from a system in which on top was the director to a system which on top we put the money and the director we put under the money. So how this reflect on the decision making? So we know that before the board of directors has power, but what does it mean? What the board of directors could do? You know, here we have some examples. The first things they can do is the amendment of the article association. I'm not sure whether some of you knows what an article association is, but actually the article association is a small book of instruction that governs how your company will take decision. When you open a company in China, you need to have an article association. In the article association, you need to specify certain things like registered capital, you need to specify numbers of directors, how the board of director meetings take decisions, and etc. Right? So it's kind of specification of the law. The law could be very general, right? The company law tells you you can have a board of director of 3 to, I don't know, 13 members, right? But through the AOA, the article association, you fix the number. You say, I want 5 directors to be the member of the board. So before the director, the board of directors meeting can change this article association as they wish. So they can give themselves all the power they want and they can do what they want. Another power that they had is the suspension dissolution of the equity joint venture, which is crazy if you think about it. Assume that you are an investor, you open a company, but you let somebody else manage it. Without you even know it, this guy can liquidate the company. So he can close the company down because he's the guy, well, in this case, the board of directors meeting are the guy in charge of it. Okay? Another power that was given to the board of directors through the joint venture, in the case, was the increase and decrease of registered capital of an equity joint venture. It means that if you open a JV with your Chinese partner, later, the people who decide to have new investors is not the former investors are the directors. So the director decide, yes, we want to accept a new investment or not. Another power is the merger and split of the JV and other things. And another point is that all those decisions have to be taken by all the director attending the meeting, unanimous vote by them. Okay. Now things it's totally reverse. Those power are in the hand of shareholder because are the one that start the investment, that they need to have a control on it. Okay, so in case there is an amendment of the article association, you need to have approval by the shareholder meeting. The investor need to say, yes, you can change the rules of the company. Yes, we can have more investment. Yes, we can split. Okay. In addition, you don't need the unanimous vote of all shareholders, but the company law now asks you just for 2/3 in order to take those major decisions. For all other decisions, you can take with a simple majority or based on what your article associate decides. Okay? And so what happened to the board of directors now? They're basically useless? Well, no. What happened is that the position of the board of directors now, as I showed you with the pyramid before, they are under the shareholders. It means they do preparatory job. For example, there is a budget. The budget is approved by the shareholders meeting, but the budget is prepared by the directors, right? So they have all this preparation job that is very valuable, and they actually hire the GM and they organize the management of the company. So they have very important role, but all the function that are like vital for the company, they're still in the hand of who put the money. So we have here the difference of the board of directors with the previous regime and the new regime. Please bear in mind, if you already established your company and is not compliant, you need to change your article association into the new regime. Okay? So if before in your article association, you open your article association and it's written, the board of directors is the highest authority of the company, you know that you need to change because now is the shareholders meeting. Okay? Right. So before, the old law about the joint venture said that the board of directors have to consist of no fewer than 3 members. Okay, so there was no option for you to have in a company with 1 executive director. Maybe if you have a small joint venture and you just want to have 1 director, you couldn't do it. Now things changed. So now you can have a board of directors of 3 to 13 directors. And if the company is small, you can have just 1 executive director. This makes the company more lean. You will have investor, 1 director, maybe 1 GM, and so on, right? Another point that is different from the old regime is that the number of directors was appointed based on the share ratio of each investors. Means that if you have minority shareholding in the joint venture, for example, you have 30%, and the other investor has the difference as 70%. In that case, if you have a board of directors made of 3 members, he has right to appoint 2, and you can appoint just 1. So it means in this case, they really look at the share ratio to decide who managed the company afterwards. So having the minority shareholding would be very dangerous in terms of who decide what. Now the regime is different. Now the company law tells you that regardless of the shareholding, party can decide. The shareholders can decide that maybe just 1 of them appoint all directors. Or they do, I do 2 and you do 1, and etc. This gives you a lot of flexibility because even though in case you are a minority shareholder, you can retain control of the company if parties agreed upon. So you can tell your partner, I want less profit, for example. but I want to keep control on the company because I'm better than you in managing the company. You have a lot of money, but you understand nothing about corporates. So you should have no say in deciding who the directors are, right? So a lot of flexibility in this regard. You are not linked to the investment ratio. So, as I mentioned before, the BOD powers were amending AOA and etc., and they need the unanimous vote. Now they have an intermediate role. So, what's another major change? Sorry if I drink water by this time. Okay, what's another major change? It's about the legal representative. So, as I mentioned to you, the legal representative is somebody on the license. It is somebody that represents the company to the outside, right? So the legal representative has power to go to another, I don't know, to a shop and sign a purchase agreement on behalf of the company because he represents the will of the company. He can take commitments for the company, right? And this is a huge power. Because regardless of what the directors say, if the legal representative doesn't care, go there and sign anything, this is valid. So third party can consider the legal representative action as the action of the company. Okay, so this role is critical. Based on the old regime, only the chairman of the board can be appointed legal representative. You say, okay, that's no problem. Why this is an issue? Well, in China, we have something called the face, the mianzi, right? So often when you're discussing the terms of joint venture, the Chinese partner want to be the chairman of the board because he wants the biggest share. Even though because on the name card, being the chairman of the board, it looks pretty cool. So when he goes developing business for your joint venture, he can use the title. And this also, without even knowing, reflect on the power, because if you give this power to him, he will be also the legal representative of the company. So he can bind the company for any decision he make, which is big. Now, this is not the case anymore. Company law said legal representative could be the chairman of the board, an executive director, or a GM. So you can make your partner chairman of the board, but the legal representative is the GM, that maybe is from your own country or is somebody that you trust more. This is pretty big. Another thing that is equity transfer. Equity transfer means, gosh, I invest a lot of money, right? And I'm tired. I just want to sell my shares. I don't want to do this anymore. Or, gosh, I want to make even more money. I'm going to sell it because the company's value now is higher, right? And this is supposed to be something very natural. You know, if I invest, I can sell to anybody. Well, with the former J venture, the problem was that in order for you as investor of a J venture to transfer your shares to third party, means, for example, to Christina or to Diana, you need to have unanimous vote, consent of all other shareholders. So if your Chinese partner does not agree, you cannot sell to third party, you can just sell to him, or you will be trapped in this company and being shareholder basically forever. Company law revolution, let's call it. Now you don't need the consent of all the shareholder. You just need more than half approving this sale to third party, or anything else you agreed on the article association. So when you open a company, you know that you would like to sell one day because this is just a temporary investment. So you make clear in your article association that no matter you want a way out, you can sell without approval. Okay? And of course, also in the company law, there is no limit for the transfer between shareholders. This is another interesting part. Distribution of profits. All of you, I assume, run a business not for charity, but for having some earnings afterwards. And situations that by the origin, profit could be distributed only based on your share ratio. It means that if you have earnings, cut the cost, cut the taxes, profit, and you want to split the profit, you can just split in the way the shareholder ratio of the company is done. So if I'm 60-40 company, 60% on me and 40 on Diana, Diana cannot take 50% of the profit. She gotta take 40 because she has a 40% shareholder ratio. So you are linked by this limitation. And this is bad because if I'm a minority shareholder, because I invest less, but I bring a lot of help to the company, so the company make a lot of money because of me, I might deserve more profit than the one that initially put more money up front, isn't it? New regime, company law said, we don't care about your share ratio, you guys decide upon. So if one of the shareholder does not want to profit, you can just say it and we will be okay. We handled a case recently of which there was an acquisition of some shares in Chengdu. And one of the shareholder actually renounced forever to the profit of the company because he would rather have the profit they have in another jurisdiction. So they have, it's a multinational investment relationship. And the partner in China said, okay, I don't want a distribution of profit in China because I don't care. I don't even know what to do, maybe taxation, etc. You get all the profit we have in China. I will get the profit in Cayman Island, something like that. This can be done now. Before it couldn't be done. Well, couldn't in theory, because later lawyers can always find a solution for different issues. And statutory funds, this is something that could be of interest also for Christina, is that before there was no clear idea how much I need to allocate a statutory fund. Statutory fund is a sum of money that you need to put as a reserve before profit distribution in order to keep some kind of like money for the company in case in future you have losses and etc. I'm not an accountant, an economist, so I'm not even sure my definition is clear. You can ask Christina later on to give you a better definition of statutory funds. What I know is that the rules before were not clear, so nobody knows actually how much is supposed to be put aside. Now, through the company law, you have a 10% of statutory reserve until reaching 50% of the registered capital. And after that, you're free to decide if you want to put some statutory funds or not. This is something, guys, that you can discuss with her because I have no clue how these economic things work. So here I put a very strange word, ni. Is a mix between no and si, that means yes in Italian. And we use this word to represent something we are not, there is a solution, but it's not very legit. It's kind of like very cross the line situation. And it's like, okay, I'm a shareholder, but I have no time to this stuff. I just want to put money. Can I just give all the power to the BOD? Or your BOD told you, give me all the powers. Can this be done? Ni means could be done, but there are some restrictions. And we don't let you read the whole thing that is, gosh, it's pretty long. The message is that you could delegate some of the shareholders' power to the BOD, you could, but you can't delegate powers that we require a shareholding meeting resolutions. So all the powers, all decisions that after you take them, you need to have a shareholders resolution and go to the bureau and submit this shareholder resolution. You cannot give to the BOD. And the answer is simple. The answer is that simple because when you go to the bureau, and Christina have a lot of experience in China, if you are not compliant with the checklist that the lady at the counter has, she won't register your change. So if you say, oh, I give my BOD, my board of director, the power to change the article of association in the name of the company or business scope, so you give them this power, when the BOD goes there and there is no shareholders resolution that they need, this shareholder resolution saying, this is the change, they won't accept the change. So delegating just powers won't be enough in this case. But you could delegate things that do not require that. For example, budget approval. You don't need to deposit the budget approval, right? So in that case, you can simply say, guys, I know nothing about numbers. For example, myself, I'm pretty bad with numbers. And I don't even know what's happened with tax and stuff, deduction and whatnot. I just give everything to the BOD, just take your decision. That could be viable solution. Okay? Not sure whether what we stand for the time. I think we're almost there. So, what's the advantage of the new system compared to the old system, right? The first thing that comes to your mind is that the dividend can be distributed, the profit can be distributed the way you want it. You could be 1% shareholder and say, all the profit goes to me. If you can convince your partner to do that, congratulations. This could be an effective form to operate investment funds, because of course you can actually have a lot of money, but keep the operation in the hand of somebody else. Of course, foreign investor will be permitted to acquire stock in private Chinese companies, which is something pretty sweet. And a lot of time what happened now is that maybe you're working for a private company, they give you the shares, but they give you just based on a contract, and your name is not on the license. Even though this contract could be valid, you understand that all the powers that are in the hand of shareholders, if you're not on the license, they're very hard to be enforced. You will have a hard time to enforce those powers. And this is another point. It's many high-tech companies, I mentioned to you, can hire foreign talents or Chinese talents and give them stock options without being worried to change the instruction of the IKEA table. You know, the instruction just one, I don't need to care. Now the board of directors is the biggest authority. Now it changed, is the shareholders meeting. So that was what's happening before. In a tech company, depending on the capital, you will just freak out to understand what kind of rules you need to apply. Another thing is the procedure for forming companies. I think these things you will actually study or read it before with the previous sessions, which right now seems the establishment of a company is way easier, even though because right now, when you open a joint venture company, you don't have all the pre-approval procedure in the hand of the authority that you need to go through. It's just much more like straightforward, let's say. And capital contribution, this is something more technical, but what happens is that you not only can contribute capital to a company, but if you're a certain dimensional company, what you contribute could be equity of another company. It's called like share swap. It's a bit complex, but thanks to this fact that the rules are unified, basically you could actually work something out. Before a company that want to do this, they use foreign vehicles in maybe Hong Kong or Singapore, the UK, and etc. So what happened to the structure, to those structure? Okay, for anything established before January 2020, you can apply still the old rules for 5 years after implementation of the law, means 2025. So the very easy exercise you need to do is that check your article association and see whether your article association follows the company law. If it does not follow the mandatory rules of the company law, because in the company law, there are certain rules are not mandatory. Be careful. If it does not follow the mandatory rules of the company law, you have until 2025 to change it. If you don't do that, what happens? Some of you may wonder, what happened? Do they come and find me or not? Well, at the moment, what happens is that if you don't do it, they will refuse amendments that you may ask to the company registry, even though not related to the corporate governance. What does it mean? It means that in case you have a new investor, you need to change the investments, you go to register the new investor because you did not change your company structure. Your board of directors is still the supreme organ. They won't allow you to do so after the 5 years grace period. Okay? And this is critical because people may just ignore it, let the time slide. Maybe nobody will come and check you. But if you have an opportunity maybe to seize an investment or change one director or do something like that, when you go to the business registry, they will say, no, you are not compliant. So all the operation will stall. You will need to change your article of association at the time, and the procedure you want to do right now, it will be postponed for weeks and months. Okay, later, before the 2020, you still could have opened WFOE EJV, means 100% foreign capital or mixed capital with Chinese. From last year, you cannot. Company will be considered foreign investment enterprise, okay, regardless of the share ratio. Before it was, I think, as 25% in order to be considered JV. Now there is no difference. And a company, there are JV, let's call it JV, but mixed capital and 100% foreign capital apply the same rule, company law. Or partnership law if you are a kind of special, let's say you want to apply a special. I think for the time, we are almost there. And now for the one of you, I'm not sure how many participants are here, but there is a big quiz that you can answer. Not sure whether I can make it through the, okay. Yes, I think you can see that. So you can use the chat to try to answer this impossible questionnaire, the possible quiz. And I think this is pretty useful because answering some question, very simple question, help in fixing in your memory certain principle. As Christina said in the beginning, this is like a training, right? It's for teaching something. And if you can get out of this seminar with certain points that are clear in your mind, in case somebody tried to cheat you or tells you, no, this is it like this, give everything to me, you can just say, okay, stop. I heard from Valentino, Diana, and Christina that this is not true. Let me check. Because one of the issues we have in China is that China is pretty far. And people tend to trust very easily other people that give you some information. Also information I'm giving myself. Don't trust 100%. You are free to double check it because double check is always valuable, okay? So first question is, can I still establish an equity joint venture right now in China, applying the old regime? I cannot see the answer, but if somebody is answering, let me see.
Can you open the chat? Can you open the chat box, Valentino?
Okay. And I see Christina say no. Anybody else want to try? If yes or no? If nobody want to try, I will show the answer. Huh? You have 3, 2, 1. Wow, it was no. Is a correct answer is no. You will see this, the poor emoji crying. Second question is Valentino and Chen. Valentino is a fictionary name, is a person does not exist in this case. Valentino and Chen are the only two shareholders, sorry for the grammar mistake, of a company in China with 50-50% like ratio, right? Valentino and Chen agree that all profit shall go to Valentino. Is it okay? Some other answer? Christina already answered. Somebody that believe is not true, is not possible.
I think people aren't so active today, Valentino.
Oh, I don't know why these things appear here, but the answer is actually yes, it's okay. Sorry guys for the missed things there. Let me go back. Anyway, the answer is yes, it's totally fine. Can be done. So Valentino can have all the profits if Chen agreed upon, because they're both shareholders. Third question. If you have established a JV in 2018, you don't need to change the corporate governance in line with the corporate law of PSC for the next 5 years from now. This is a bit tricky because it's the time calculation, which require numbers, and it's terrible. Any idea?
Sorry, Valentino, I just have Doug who might be needing to get offline soon. He's asking, he just has a quick question in relation to WFOEs turning to FIEs, because you've been focusing a lot on JVs.
Yes.
So his question is, he's got an existing WFOE in China.
Yes.
So what needs to be done regarding the WFOE?
Very easy. You need to take the article association and compare it to the company law. You need to have your consultant, in case Christina or the others, to cross-check, because in the beginning, the WFOE were established in accordance with the WFOE law, and they usually follow the company law. So most of the WFOE are in theory in line with the company law, which is great, but not all of them. We saw some WFOE that, because what happened in China is that a lot of company registering small town register WFOE in a very weird way. We saw a WFOE without supervisor. This is something impossible. We saw a WFOE with a board of directors being the only organ in charge of everything. So in theory, the WFOE is supposed to be okay, but what is okay is actually your article association. It's not the name of a company. So the most critical are JV, because for sure they're done in a strange way. But the WFOE could be still strange. So we do suggest you to double check. We had an inquiry by a gentleman from Germany that was in a free trade zone, opened a company 18 years ago. And he said, I open a WFOE, what should I do? I say, man, you better look at your article association, because 18 years ago, the company registry could have done anything.
I just want to add something there as well, is that if you were using either the promotions bureaus of zones,
yes,
or using local agents to establish your companies, in the majority of cases, the articles of association were direct government templates and were not expanded upon. So it's very good, if your company was established prior to 2020, to just do a quick review of your articles of association to make sure that they are up to the current company law standards. So like Valentino said, 18 years ago, actually the supervisory law didn't exist. So if you never updated your articles of association since 18 years, then already, even without the new foreign investment law, you're not in compliance because you don't have a supervisor within your organization. So and the supervisor thing I've seen often, that companies don't have them. So it is just wise to take the articles of association, have a check. I already know a lot of companies that can't find their articles of association and don't have a record of it and no longer have a contact with the agent that incorporated their company. So if you do have those issues, copies of the articles of association plus any follow-up resolutions are stored at the Ministry of Commerce or the bureau where you registered your company. So
Yes.
again, if you don't have copies of it, make sure you get a copy of it and you know what follow-up resolutions were made, so you know where you're standing today.
Yeah.
Douglas,
And-
oh, sorry, go ahead. Go ahead, Valentina.
Just to say that if you want to retrieve them, because they are in this bureau, right? How to retrieve them. You can appoint somebody using your company shop and say,
Yeah.
this person can print the things out, very easy. Or you could use lawyers. Lawyers using the lawyer license can go directly, even without authorization, and print things down. We did something like that last week in Shanghai. So don't worry about that. Documents can be retrieved.
Valentino, maybe we just go through some questions because I think some people are gonna need to get kicked off.
So you can just tell me all the things that you want to answer. I will answer.
Okay.
Yes.
So one thing that you mentioned, particularly for those that have joint ventures, you were really focusing a lot on AOAs.
Yes.
What about joint venture contracts?
Yes. I like the evil question by Christina on the joint venture. So which is the things of the joint venture contract? The joint venture contract usually just copy and paste the article association. Okay, when you deposit the joint venture contract, it's like a copy of article association plus other information like raw material, who does that. It's like an expanded version of it. Okay, so right now for the company establishment purpose, it's not necessary. You need to have article association, right? And the joint venture contract that you sign, all the parts that are not in contrast with the company law are still valid. So in the future, what we will see is that your joint venture contract, it will be just a shareholder contract that will be just, it will just incorporate the main terms that the shareholder agreed upon. Like I put, because what happened is the joint venture contract usually puts who give the building, who give the raw material, who bring the IP, these kind of things, right? So those kind of things can be still done, do not need to be recorded, can be between parties, and you can actually have it in a form of investment agreements or whatever things. So those things will be okay. The court will still support it, but the court won't support things about corporate governance against the company law. So in your journey, yeah.
So are
please.
you ultimately updating both documents simultaneously?
What you could do if you maybe lazy, you will just update the AOA, a joint venture agreement. What you will do, you will just cut out all the part related to
The old regulations.
the old regulation, and just keep the things about, they're really about investment per se. Like, okay, these gentlemen, we give they usually give the building free of charges for the company, this kind of stuff.
So I've heard stories. So I'm helping just WFOEs basically in terms of reviewing their articles of association, but I haven't been doing anything with joint ventures. So I'm just curious, from your perspective, there are multiple shareholders involved. And obviously, if you're going to be updating your articles of association, I assume there has to be a shareholders meeting that is then negotiating and agreeing to the updated terms. From your experience so far, how, my assumption is that the government has placed a 5-year period to get this done because of potential negotiations and back and forth between the shareholders. What have you seen so far, or do you have experience so far in terms of these types of negotiations?
Yes, we actually representing a French company, this JV revision. And we see a lot of similarity with a divorce.
Oh, really?
Yeah. Because basically what happened is that the board of directors before was run just by the Chinese partner. Okay. At the moment, the Chinese partner was very happy because he's full power.
He has control.
But now that you put on top of him the shareholders meeting, our client is the majority shareholder. He say, no, wait, even though you are the majority shareholder, I don't want you to control me at some point. So there is a lot of discussion about the appointment of directors, who can remove what. Because as I mentioned, the flexibility is good, but any flexibility in case of negotiation also make the negotiation harder, because actually you can be empty-handed. If the guy put you pressure, say, okay, or either you decide my terms or we liquidate the company, you start thinking twice to put control on it, right?
Right.
Because that's the thing. If you don't change the situation, you have nothing else to do.
So do you feel that the trend will be that there will be more divorces coming up in the next 4 years?
I think there's going to be a lot of lawsuits and discussion, I think, especially in the, I think, 2023, 2024 year, because they are just before the end of the expiration.
The
I think
deadline,
now,
right.
yeah, the deadline. We are just at the beginning of it. So people are still pretty nice. And actually, this is an advantage of people that want to put pressure. Because if I want to put pressure, I will just wait. And that's also why I'm telling people not to listen too much of what they heard. Because a lot of people will tell you, 5 years, let's discuss in 3 years from now.
Mm.
And if this happens, you have your hands tied. So there is nothing you can do.
A question that I had regarding Diana's presentation about the equal rights and the equal rights being provided to companies now. So I think this is very useful actually for companies, whether it's a joint venture or a WFOE that were established prior to 2020. Many of them might not even know what policies exist that they can actually utilize now. So a question that I had was, how do you find that out? I mean, if I make up a scenario. Imagine you were setting up in a zone because you just needed to be in that zone. The location was perfect. You were not fulfilling the criteria to, I don't know, get a tax benefit. I'm making this up, but to get a tax benefit. Under the new foreign investment law, you should have that capability now of benefiting from this new tax rate and whatnot. How do you find out about it? How do you go about attaining it? Is it a matter of meeting with the zone's promotions bureau? Is it a matter of getting a lawyer to do this review for you in terms of getting these equal policies?
Well, in general, all the, I mean, it's you have to look at it location by location, because in many provinces or areas or free trade zones or whatever, this is going to be publicly announced, and there are the official websites which announce these things, which everybody who follows should have access to them. In general, especially when it comes to tax, this has to be public knowledge. So it's a question of how easy you are going to find it. And once you find it, you then have to claim it. And again, it will depend on the administrative body that you have to claim against. And they should be so nice to adhere to your claim, because now it's black and white written in the law.
Right.
I think the message has been pretty clear throughout the whole kind of spectrum of organs in China that equal treatment should be offered to for foreign enterprises.
Right.
And of course, if you have any difficulties, you can always call for specialists to do the work for you if you feel uncomfortable or incapable to find the right answers or the right avenues.
Okay.
There is also, I can also add something on top of that. Every major cities has investment bureaus.
Yeah.
For example, there is a bureau called Invest Guangzhou. There is a bureau called Invest Shenzhen.
Was there also Invest Shanghai?
Yes, Invest Shanghai. Usually those bureaus have a website, as Diana said, also in English. Plus the major policies, they are really big announcement that you can see on the website. For example, I think in Shenzhen, there is a new policy for bringing the headquarters of company in Shenzhen, and they have some kind of tax rebate about that. I'm not very sure about the details, but I saw many announcements. So you either drop a message to an email to the investment bureau that they will answer you back, or you just follow up the website, because those things will be published like in gigantic characters in the beginning of the website. So depending on where you are. Another thing that is what Diana mentioned in the beginning is the investment contract. There's something that you should seriously evaluate. So if you are investing, would like to invest in a certain area because you believe that area is of interest, because for any reason whatsoever, you should try to reach out the authority, even though there is no public announced, let's say, policy, because they can grant you that. regardless, there is nothing at local or national level. So they can tell you, oh man, you're coming with Nike. Gosh, you're so big. We are gonna give you tax rebates for the next, I don't know, 10 years or something like that. And this contract, as Diana said, is enforceable. So if they don't do what they say, you can sue them.
Yeah, I don't think the clients that are watching this are going to be the Nikes of the world, but they might have smaller investment contracts available to
I
them.
have a very nice, let's call it Cinderella stories about that, like call it this way. The guys that went in the middle of nowhere of China, and because what they were doing was like in connection with artificial intelligence, the government give them a lot of facilitation for visas. They give them the building all free of charge for like, I think 3 years, all those kind of things.
Right.
So, and the guy was just moving there because he thought it was a nice place.
Right. Yeah, you have to be open to that discussion.
Yeah.
Valentino, you opened the can of worms regarding stock options. And I know this is now becoming quite a trend, especially for companies that are incorporating in Shanghai. I don't know if that's the case in Southern China or not, where companies are looking to provide stock options to either local or foreign employees that are going to be based in China.
Yes.
One of the things that you were mentioning that I thought was very interesting is that unless you are actually put into the shareholdership structure and it's registered with the government, you have very little say. So how are companies promoting the concept of stock options? How is it actually physically working? Or how do you create a structure that is legal and then gives the right authority to the employees?
Yeah, not to give advertisement to the firm, but tomorrow there's going to be like a seminar, unfortunately just in Chinese, about this, about shareholder structures, incentive for internet company, because we have a very big high-tech internet department here. So we do a lot of those kind of seminars. You need to look at what the stock option is. So if this stock option is given just as a matter of profits, people maybe don't even care. They have nothing to say about the organization of the company because their value is so little that even though they have something to say, unless they join the force, there is nothing they can
authority.
Plus there are like, let's say, I don't want to say like some stock with priority, but kind of golden shares that are keeping in the hand of people of powers, which even though I give you the stock option, you can do basically nothing. So more than on a big company, this is important for smaller companies, in which, for example, can make a classic example we face in the past, the chef of a restaurant is like attract to come to China in exchange of the shares of the restaurant. So you work hard and they'll give you shares. And now we make you owner of the restaurant. For them, every share count because the dimension of the company is very little. So in that case, let's say your argument as a merit, because how can they really control it? Well, they're supposed to file a claim before the court and say, I was the real shareholder based on the contract. I have right to take those shares. Please force the partner to give me those shares. And this will happen. The problem is that during this period of time, you really lose control because there is really nothing you can do. You need to wait for a judge to really force them to do it.
Understand. And what about, I mean, you were talking about internet companies, which I think is really interesting. There are a lot of app developers that are opening up businesses in China. And, you know, these are companies that are going to grow to 100, 200, 500 people. And, you know, they're looking to provide what they call as stock options. But ultimately, I like the way you differentiate it. It's gaining a percentage of the profit more than anything else, right? They're not decision makers.
Yes.
How would you structure that in China? Because
in
the end of the day, it's just, I mean, if you're not going to put them in the shareholdership list, then ultimately they're just getting a bonus based on the profitability, right?
What usually happens is that you open a partnership. You create a pool of investors, they call it, and this pool is just given to the employee as a benefit. And this pool has a connection with the main company that give,
Understand.
let's call the profit to them, and they are in this pool and enjoy, let's call the profit of the
But then it's a partnership structure that's created.
partnership, because in this way they don't have say on the company per se, because you have the partner that has power to just control the partnership.
And in the partnership structure, do you have to have equal percentage of shares?
No,
It can vary. So one person can have 1%, another person can have 10%.
you can just do the way you want. And you can actually say who among them will have the management of the partnership. And all the others will just have the result. Let's say.
I understand.
This is one of the structures. There are many. There are some companies that do the structure abroad. It is something that also feasible, especially the one that go listed outside China.
I understand.
So they create a pool of stock option in Cayman Island and other places, and you know all the employees got stock from there. And this company is the one that will be listed, so
Right.
they're sure they're gonna have earnings and that. Yeah, this is one of the things.
Two more questions. One was you were talking about decision-making power in the joint venture structures moving from the board of directors to the shareholders meeting. When you're looking at a WFOE, so
Yeah.
sole shareholder basically, is the decision-making power with the shareholder, or
Yes.
is it with the board that is created or the executive director that is appointed?
Yeah, well, the power will be on the sole shareholder because you won't have a shareholders meeting because you have just one investor.
Right.
All the powers of the shareholder meeting will go to the single share. Later, if under him he decide to have 3 directors or just one executive director, this director we have the director's function, means all preparatory job, right? But one thing to bear in mind in China is the importance of the CHOP and the legal representative. Because even though you are a shareholder, if you give the CHOP to somebody,
They have the power.
they start chopping everything.
Right.
Chop all the signature of the legal representative buying the company. So if they sign a bonus for themselves of 500 billion trillion, this could be sustained by a court because they say you are careless in giving them the chop, but this is the result. So it's okay to take care of the, let's say, corporate governance, but the possession of the chop is critical, and the appointment of legal representatives as well.
One last question that's popped in is what's the purpose of the statutory funds?
Yeah, well, it's supposed to be used in case the company first goes bankrupt, need to pay some debt, or pay the losses. So in case 1 year you have losses, you have the statutory fund is automatically used to pay part of the loss of the year. So this is in order to safeguard the fact that those companies are not empty boxes.
Correct. Yeah.
So they tell you, okay, you had some profit. Those profit you cannot put in your pocket and run away. First, you need to make sure that you provide for the statutory funds, because if you leave, your employee won't have any severance.
Right.
Your creditor won't have a say, and maybe your company is nothing. How many people respect the statutory funds? Big question.
I think at the end of the day, people try to take their profits out prior to
Yes.
putting anything in the statutory fund.
Cost. Like, I bought a phone, I paid like 100 million RMB for a phone. So how's it even possible? Yeah.
So yeah, I mean, that's what we're seeing is that most people try to repatriate funds prior to putting anything in the statutory fund. All right. Well, that's all the questions that have popped in. Should we finish? We've got another 10 minutes to go. Should we finish the quiz?
Yeah, well, yes. Where will we? Like
On
Valentino? Okay.
on number 3.
Yeah. So the question is that if, yeah?
The last question.
Yeah. So if I open a company in 2018, do I have 5 years from now to change the company? And the answer, if somebody has the answer is actually no. I'm not sure if I can appear the faces, but because they are messed up with the PPT, I won't show the faces. Is a no, because from now, it's 2021, you have 4 years. It's 2025, the deadline is not 5 years from the day you decide, it's 5 years from the implementation of the law. Later, Valentino wants to sell his shares to Carlo. It doesn't need the approval from Chen. In this case, a joint venture, Carlo is a third party, Chen does not need to approve. Also in this case, the answer is wrong because Chen need to approve unless on the article association they say that Valentino can do what he likes. Going further, I have a company established following the company law before 2020. Maybe I don't need to change anything. That is maybe yes.
Maybe no.
Yes. Because if you follow the company law, your article association is supposed to be in line and you're supposed to be safe. And here I specifically mention company because in the past we saw joint venture established following the company law. Don't ask me how, but we see all strange things in China happening. So check your article association. Further questions? The most important organ of a company now is the board of directors. No. Are the shareholders, the money, let's call it. Next question, the foreign investment law cancel the old laws about foreign investment. Yes, there are no more WFOE law, no more equity joint venture, no more contract joint venture. We just apply company law or partnership. Later, new regime give more flexibility in management and profit sharing.
Yes.
Yes, we can decide how many director appoint or appoints and how to share profits. This is pretty nice. Later, a similar question as before. I have 5 years from now to change my corporate governance in line. It's not 5 years from now, it's 4 years from now.
4 years, 9 months.
Yes. Last question, the board of directors is useless now. The answer is no, it's not useless, it's very useful, has a different role than before. So it's not like, okay, it's useless, just don't mind about that. Because if you appoint the wrong directors, you may still have troubles. So you need to really take care of the corporate governance, guys. And for me, it's okay. For Diana, I think it's okay. For questions, we're fine. And in case you have further questions, please address to Christina or to us, and we will answer in the coming days.
Thank you so much for sharing with us. I'm just switching the screen.
Yeah.
So just to finish off, if you guys are willing to chat, let us know what your biggest takeaway from today was. I think my biggest takeaway is to grab my articles of association and review it clause by clause to make sure that it's in compliance. If you guys want to reach out to Valentino, Diana, or myself, Valentino, maybe in the chat box you can just put your email or WeChat ID
Yes,
so that people can reach out to you. I will just do the same, and put that in as well. All the details. Let me put that in. Great, thank you, Diana.
There is our boss behind. I don't know if you see a ghost, but that's our boss came to supervise us. Very scary. Look at that.
And just to finish off, we've got 3 more webinars in this series. So tomorrow I'm going to be looking at how to analyze and review your financial management reports in China. On Thursday, we've got a debate talking about opposing objectives between head offices and China subsidiaries. And I'm hoping people will join that because I've just actually written out the questions and it probably will bring out a lot of sensitivity and interesting debate amongst the three of us that will be speaking on Thursday. One of the things that I definitely see is that growth sometimes gets halted because of the opposing objectives and the fights that occur between head offices and China subsidiaries. And then on Friday, we're going to finish off with 10 reasons why companies aren't successful in the Chinese market. So if you guys are interested in signing up for those, go to woodburnglobal.com/events. Like I said, we were recording today's session, so it will be put up on our YouTube channel later this afternoon. Valentino, Diana, thank you so much for joining us. Really appreciate it. Thank you for also the quiz and for the Q&A. Yeah, if you guys want, if you're running joint ventures, or even if you've got wholly foreign-owned companies in Southern China, please reach out to Valentino or Diana and get your articles of associations reviewed, just so you know what you need to do within the next, what is it, 3 years, 9 months, I think it is.
Yeah.
And make sure you're doing it all in time. Thank you all for joining us. Have a great afternoon. Have a great evening, Valentino, Diana. Take care. Goodbye.
Thank you so much. Goodbye.
Thank you.